Thank you, Amit, for joining us today on Let's Talk Business by Reality Next.
Thank you so much, Kritika. It's a real pleasure to be with you on Reality Next. I'm amazed by the cutting edge information and research that you're doing at Reality Next, and very happy to be part of your endeavor.
Thank you so much. So, Amit, before we delve into the business of finance and investment, let's talk about you. I want to know what inspired you to enter in this particular industry and make our viewers go through your journey, the time you entered till now you have become the founder and the CEO, managing director of Nisus Finance.
Sure. Thank you, Kritika. Something that I generally don't talk about, but happy to share. In the last 25 years, I've seen a large ecosystem within India, within financial services and investments. It started with the traditional way of investing, which was either through equities or through mutual funds and very select private equity. My own journey, I was involved with very large corporates, managing their treasury, managing public investments, and managing private investments as well through mergers and acquisitions. I was then given an opportunity to be part of a very large global buyout private equity fund, which effectively culminated with the global financial crisis of 2007-8. It's then which I realized that it's not always about the story of a sector or of economy. I think it's important for us to figure out if there are ways to protect capital and to ensure that we do not face a similar meltdown in our investment books as we saw in 2008, because that was a shocking event for global financial services and investments worldwide. And it almost has taken 10 years for global economies to actually come out of that recessionary environment. So sitting back in 2007-8, having invested a very, very large sum of money in private equity and in buyouts, which had melted down to negligible valuations, it set me thinking which is the best way to actually protect capital. And thinking about safety, I realized that there are two ways to do this. The first is look at debt as a product because they are looking at a mortgage back or a assured return rather than any equity upside or volatility based returns. And second, within debt, what does one do? And that's really when I chanced upon mortgages. Now I realized that in India, the quality of mortgages is one of the best in the world. We have one of the most solvent mortgage books, and the delinquency ratios are less than 0.5%, which means if there is a way for us to actually discount mortgages in a running residential project, which is largely mid-income affordable housing, and it is obviously bought by first-time home buyers who are buying it on mortgages. In India, the rules for mortgages have always been more tough and more stringent compared to any other mortgage industry worldwide. Very many people are not able to access mortgages, and even if they did, their own contribution tends to be very large. So that was the first sort of thought that came to my mind is, can we do this simple idea of discounting mortgages? Fortunately for us and unfortunately for financial markets, there was no securitization product or market in India way back in 2007-8. So we said because of this entire collapse or global collapse of financial services and capitalization in the country, where banks have really stopped functioning, private equity has disappeared, and those are the only two modes of financing. There were no NBFCs, there were no other private funds. We decided to introduce this product, and I thought because I've seen similar products internationally where I was involved in, which is in the nature of RMBS, which is a residential mortgage-backed securities. That was a synthetic product. I said if you have to do a simple securitization, then that may work. That's when we started identifying projects which are well sold, well constructed, and need that sliver of capital to be able to tide over the completion crisis, which was percolated during the GFC of 2008. So we started capitalizing those companies by receivable discounting and issuing of bonds. So that was the first time in 2007-8 that NCDs in India actually were issued for the first time by real estate companies. There was no market till then. It was a very new product, so it took us time to understand it, perfect it, and securitize it. But it had phenomenally great outcomes. We were able to completely ring fence our investment by completely securitizing the entire receivables by way of escrow of the bank accounts. We were able to take control of the entire project as a whole as part of the mortgage security, and which allowed benefits to both parties. The project company was able to get that very, very essential capital and able to complete and accelerate the project where there was no other means of capital available. And likewise, we were able to earn a very superior returns compared to what the mortgage rates were.
Mm.
Because obviously a remortgage industry does not allow much margin, but securitizing these mortgages in the hands of the recipient, which is the developer company in the escrow account, really made a lot of difference. So that really set up the tone for us to further this product and propagate it widely. Fairly many private equity funds or domestic funds started to realize this product and started to introduce this as part of the investment strategy and thesis along with us. So this period between 2007-8 to 2012 is really when this entire NCD or private mortgages or discounting business really blossomed to a reasonably large play. We were at the forefront of that business, and we are always very certain about our strategy because having seen 15 years of challenges and cyclicality in financial services and investments, it was very important for us and for me to ensure that we kept our investment very tight and very secured. So it was never really about figuring out which new project to back. It was
Yeah.
always about creating a cash flow based
Mm.
securitization product, which could always ensure that irrespective of the macro environment, irrespective of what happens in a geopolitical environment,
Mm.
that money will always come back to us. Because in India, once you've paid 30, 40, 50% of the money, every home buyer is excited, keen, and anxious, or even nervous about getting possession and
True.
paying that difference
True.
and paying the balance amount. So, therefore, irrespective of what happens
Mm.
globally or even domestically, that security is absolutely pristine in our minds.
Mm.
And we've been proven right over the last 15 years, Kritika. I'm very happy to see that whatever we decided then or
Mm.
whatever we discovered then has been proven to be absolutely solid. Mortgages and mid income affordable housing buyers continue to be very, very solvent and diligent about purchasing, about paying, and taking possession of their homes. So it obviously served that purpose. We obviously then saw that in 2012 the AIF regime came into being, and that allowed us to formally pool capital. Till
Yeah.
such time, it was done either through a PMS or in partnership with foreign funds and things like that, or people who had capital under different routes.
Mm.
But it was only in 2012 that we were able to actually get the license for an AIF, which was a new regime then, and pool domestic money. That's when we really launched the first fund. And we've been doing multiple funds since then with this singular idea that
Mm.
A, we will go after mid income affordable housing, B, it will be all brownfield projects. That way,
Mm.
we're not taking any risk that we can't manage or underwrite, which could be including title or approvals or construction or design or market acceptability or sales. None of that because it's
Mm.
already a discovered product. It's already selling well. It's already got enough buyers in there. A significant portion of it is completed and sold. So the risk factor affiliated with a new launch has already been taken care of. Now it's only about ensuring that the cash flows from that project come back soon enough for us to effectively recover our capital. So that's really helped us so that even when there were larger events, Kritika, whether it was a GFC, after GFC, a demonetization, or a RERA, or a GST, or even the Black Swan event of COVID, we've never had any challenges with our investment. So this whole idea that real estate can be
Mm.
a safe haven, and our grandfathers and our forefathers always thought if you have to invest, put in gold or real estate.
Yeah.
Somehow, because of all this complexity of investing in AI funds and investing in under construction and
Mm.
buying in all sorts of different formats,
Mm.
people did have bad experiences. And I said, how is that possible? I mean, we've as a legacy, as a heritage, we invested in real estate. There must be
Mm.
something solid about it, and that's absolutely true. So what's important is that you have to go back to the basics, and the basics of real estate are very simple. There's land which does not depreciate. I
Yeah.
have not seen any asset in India actually fall in value over time. It's only either remained flat or it's gone up.
Yeah.
Unlike we've seen bubble formations in globally across major economies, whether it's in the US, whether it's in China or other markets where asset prices have actually collapsed. In India, fortunately, because we're underserved, we're underconstructed and underdelivered, we don't have that scenario where a product, let's say, was sitting in this beautiful studio with you in Andheri, and let's say it's selling at 24,000 today. It was at 12,000, 13,000. It's never going to go back to 5,000 bucks a square foot.
True.
It's improbable, it's impossible, right? So that benefit we always enjoy in India, that asset prices will either stay flat or go up. I think that's a huge benefit for us. The second advantage I saw with real estate is that it's very fundamental in consumption. It's not a trading asset class. People are not buying to flip it and sell it and make money like a commodity asset. It's actually a consumption asset class even till today, and that's very important, right? And second and third most important aspect is the fact that if you look at any project or any development, even if it has got stalled and completes even in 10 years, there'll always be demand at a certain price. So there is no obsolescence of real estate. It's not like people are going to stop buying homes and say, okay, now we're just going to go and stay in hotel apartments, or we're going to stop consuming office spaces, right? So it's very fundamental. And so there is no obsolescence issue. So whatever project you've invested, which is a good, sound project in a good city, in a metro city, in a key micro market, which is serving the needs of that locality and micro market and consumers, even if it is delayed but completes, it will always find value, it will always find monetization. And those are the fundamentals that we've always played on. So we've not got into fancy DCF or cash flow based discounting valuation saying, oh, this is the present value of this project, and therefore let's give so much money to the promoter and reward him. Because that is not to reward the promoter for not completing a project. And so a lot of people have actually put out too much capital, which have rewarded the promoters or rewarded or created, I think, abnormal gains or incentives, which are contrary to the fundamentals of debt. So if you stay true to debt, and if you stay true to the whole idea of securitization, then I think that's a beautiful opportunity for everybody. And that's really what, so as we started dabbling in it, we saw successes. We saw more capital coming in. People were super excited where the interest rate regime was 10%, 11%, or 12%. We're able to generate a significant alpha because we're addressing the short-term liquidity need in very well constructed and delivering projects. That created this whole euphoria that there can be an alpha in a credit product. You can generate equity-like returns in a credit product. So it was a discovery by chance. It was maybe led by the GFC, and otherwise, honestly, if you ask me in 2007, would I be in real estate and doing this? My answer would be heck no. I mean, I'm very happy doing mergers and acquisitions or private equity or leverage buyouts, and I don't think I would do anything else. But just the fact that this crisis led to this thinking that how do we create solutions such that we do not foresee this problem again? Because it's very hard for an investor or investment manager when you've put 5 years of hard work to find investment opportunities, to curate them, to invest them, to and you're hoping that you'll make a large multiple or exit one day, and everything falls. It's very disheartening. And more than that, for me, it's even more relevant because as a manager, you're facing your investors, and then to go back and say, I'm sorry, it didn't work out, I think is disservice. Because when we've seen people go out and raise money, we've raised capital, there's a lot of stories, there's a lot of promise, there's a lot of good days are coming, outlook which is provided to each one of the investors who are willing to believe in your confidence. And because of either the product being not super enough or the environment not supporting your strategy, cannot be a good reason for us as investment managers to go back and say, I'm sorry, we didn't do it. So that was a very big driver for us. And again, India is a conservative nation. Of course, today with a lot of the new age products, people are willing to take risk. But I think savings is still a very large part of our economy. People still want to go back and save money, put it into fixed deposits, put into banks, put into debt mutual funds, have a certain amount of fixed income in their hands rather than on a multiple. And so therefore this product really, I thought, did very well for the Indian domestic investor.
Yeah, but the time you noticed the need gap and the problems and the time you came up with the solutions, let's be honest, real estate that time was not an organized sector, right?
No, it wasn't.
And you defined a true meaning of what is an entrepreneur, because entrepreneurs looked at the problems and provide the solutions, and you did that during those times. How did you navigate through this unorganized real estate sector, and what kind of challenges did you face, and the lessons you learned that had shaped your approach when it came to the current real estate market, or even came to your leadership style?
No, very true. Great question. Of course, there's been a lot of introspection and a lot of learning in the last 15 years. And I've been very fortunate because I started this real estate journey and investing with Knight Frank as a director there. And I was given a fairly open rein by the management to try and do these products, try and do these investments. We, in fact, even did the first private REIT way back in 2008-9. Because I realized that it's a beautiful time to invest into pre-lease commercial assets. The valuations have fallen in 2008. People are happy to give away their assets at a discount. The interest rates had compressed because, like we saw in during the COVID environment, where interest rates fall whenever there's a global black swan event.
Yeah.
So interest rates were low and yields were high, which means I could borrow at 8% from the banks and I could enter into a pre-leased asset at 12%. So that's a fantastic time when you actually have a positive spread between the yields and the interest rates. I think that's the time to buy commercial pre-leased assets, especially if you're getting good valuations. So we built that book as well, and it was our first private REIT, and it did really well. And so I think cutting my teeth into real estate by a granular understanding of the markets, of the idiosyncrasies, of the regulations, which are so different and so varied from state to state, city to city, corporation to corporation, understanding the nuances to what can go wrong. If I'm investing, can I be stuck because of approvals? Can I stuck because of occupation of that premises? Can I be stuck because of non-compliance? Understanding the challenges is the first thing, because it's that really risk that you need to underwrite first. We understand that, okay, real estate is a fundamental asset class and the thesis all looks fine, but it's really the granularity which creates the problem. And many people actually miss that. They go with the thesis, they go with the big story. Let's invest in this big story. The problem is that the big story is fine, but it's really the gaps within that big story which create the problem. So I said, let's first plug those gaps. So let's understand the sector backwards. Let's meet as many people, as many investors, including people who lost money. A lot of money came between 2005 and 2008. Almost some 13-14 billion dollars came to the country, and people lost it. And saying, okay, there's something which has gone wrong. Okay, so GFCs may be one reason, but again, India is still a fundamental real estate country, and so it's not as if because of GFC the prices in Powai have fallen from 8,000 to 3,000. So how are people losing money?
Yeah,
they've invested in Powai, they've invested in good micro markets. There's something which has gone wrong. So understanding, so there's a huge learning that was available, fortunately for us, in 2008 because of the mistakes that people had done. We said, let's first figure that out and understand that we should avoid these at all costs. Then let's understand the idiosyncrasies or the nuances that people won't tell you, which is the technical aspects of the business. So today, as an investment manager, we pride ourselves in knowing the business backwards. So even if somebody tells us a story or tells us a hypothesis or gives us data, unless it meets our own internal diligence, our own understanding, we're completely satisfied that it has met all check boxes, and we are ourselves convinced of the thesis, of the whole idea, of the whole math, we will not invest. It's not just based on what an agency tells us, what a borrower tells us. It has to be based on our own learning and understanding. So I think that's what some people have missed in the past. In terms of the way things have moved, of course, there has been a separation initially between the big boys and the not so big boys. So there were always tier one guys who started becoming bigger and who started consolidating even back then. And there were people who were mushrooming or were starting business or were mid-tier or not so great guys. But they were the ones who really needed this capital the most. So it was not really, because once banks started up, and of course we gave money to the big boys between 2008 and 9 or 10. But once the banks started up again, capital started flowing only to the big boys. Like we're seeing in the current environment.
Yeah.
It's only available to the big boys, which means that there was still a very large market, because that time the organized market was barely 9%. And 91% was fragmented and unorganized. Now that's really where the capital is needed, which means you needed to be even more careful as to who you're going to work with, what is your counterparty worth, are they diligent about your capital, are they really grateful for having got this money to be able to tide over their asset liability mismatch, or are they just looking for liquidity to do other things?
True.
So I think that was very important. So that's really what kept us true. And of course, we also realized over time that it's not an investment asset class. Real estate
Mm.
actually is an operating asset. What very many people think is that it's okay to lend money, you've got your mortgages, you've got your cover, everything looks good on paper, money will come back on its own. It actually
Mm.
doesn't,
Yeah.
because there are just too many leakages in our system. There's just too many ways in which capital
Mm.
or valuations can dissipate. And we've seen that, Kritika, in the last few years, starting from 2007-18, with the downfall of some of the largest NBFCs in the country, with the downfall of several large banking institutions, wherein underwriting was not strong enough, or maybe the monitoring was not strong enough,
Yeah.
or there was a mismatch. And obviously, that's something which shouldn't happen, and that's something we are always cautious about.
Mm.
Is that monitor every day, monitor every week, ensure that whatever you signed up for
Mm.
actually comes to you. Okay, so whatever sales, whatever collection, whatever receivables, whatever construction has to happen because you obviously invested for that. Right, so that's very important. That and which is why today we have one of the largest teams on per dollar invested in the country. A
Mm.
24-member team running a $100 million book. It's usually the reverse. It's
Yeah.
a five-member team running a $100 million book.
Mm.
So that's very important for us, is actually monitoring every asset, every cash flow. That's what keeps things tight and true.
Mm.
It's not just about distributing money, because the challenge is that it's a curated product. It's a job shop. Real estate is not a mass manufacturing environment where you keep on, having line manufacturing and the product keeps on rolling out, and therefore, quarter on quarter, how much
Mm.
the factory is going to build, how much is going to get sold, what the market's absorbing. Every project is unique.
Yeah.
It's a job shop. You're actually curating a particular product for a particular micro market, for a certain target consumers. And because it takes that much effort to actually create a curated product every time, it leads to a lot of disconnect or a lot of issues within the
Mm.
system of the producer, because they're trying to maximize their own outcomes with every product that they're going to build.
Yeah.
So there could be a disincentive between what we want,
Mm.
or a disconnect to what the producer wants or the borrower wants. And therefore, it's very, very critical, because there may be nothing else after that. There may be no new project after that, or the next project may take some time. So then what do you have recourse to after this project is done and dusted?
Yeah.
So that's why it's very important that you actually take control of whatever asset, whatever project you've lent to or invested in, such that the returns actually come back from that, right? So monitoring, so it's an operating asset class. I
Mm.
think we must make no mistake about it. And it's very different from what people have seen in global economies, right? Because there the systems are different. It's a wider, broader market. People are actually creating multiple projects, multiple assets concurrently, and each capital that is deployed can actually be recovered across the stream of cash flows or opportunities or projects. So that's not the case here. It's very
Mm.
hard for a developer to have 50 projects at a time. It's very normal for global developers to do that.
Mm. Mm.
So that's very, very, very important from my perspective. And so, Kritika, I started with two investment ideas way back in 2008. One was the credit product
Mm.
with receivable discounting in late stage projects. And the second was this whole REIT idea, private REIT. We didn't have REIT regulations back then, so we borrowed it from the Singapore REIT regulation and said, well, we don't have one, so let's try and figure out how to actually
Mm.
run a private REIT. And we did that in 2009-10. And that did very well. But then again, when the markets went back up, the yield curve inverted,
Yeah.
which means that the cost of capital was higher and the yields compressed, which
Mm.
means we were like running into negative yield territory or negative spread territory. And I wasn't convinced that that's the right thing to do,
Mm.
where you're earning 7%, but you're paying 10%,
Yeah.
effectively earning net a lower amount. So I thought, therefore, leverage is actually not helping. And what, of course, I think rental yield is a leveraged asset
Mm.
class. That's how you make your multiples, your returns. So we've really stayed away from that over the last 10 years, from rental yield products, because of this mismatch, which has been persisting for quite some time. Now, maybe for some time, it reversed. And again, it was a short period where there was an opportunity. But again, there's just too much capital flowing in, which means then again, you're looking at suboptimal assets. So, but we're again considering that. We think that because of the cost of capital being high and the need for capital also being higher, there are opportunities to actually get into leased environment, but with a different strategy. So that's something we're now toying with again.
Mm.
I think there's an opportunity in a shared environment space, where people are happy to collaborate in office spaces, happy to collaborate in common living spaces, And I think there's a huge opportunity in that space because it's still a fledgling sector from that perspective. And I think that's really where the growth is likely to be. So we're going with that. So we've traditionally, as a person, I'm fairly anti-system or anti-cyclical, where I will go in when the markets are falling and come out when the markets are rising. So when there was too much liquidity in 16, 17, I actually didn't invest. I said, let everybody rush in with their money to whoever they want to lend money. And we're very happy that we didn't because, we're seeing the problems that a lot of these books have had by having put too much capital to work in a very short period of time. We said we're happy not to get into this entire froth. So it's always about being counterintuitive. It's about thinking what others are not thinking or seeing what others are not seeing because everybody's seeing, the challenges or the opportunity right in front of their noses. I'm seeing what lies beyond that.
True.
So I think that's just how I've been built, and that's how we would do our business.
So coming back to your statement where you say, I see things beyond that. In Indian real estate market, we have also seen a bit of downfall of few developers where they have promised certain projects, where they have promised certain, possession date to the home buyers, and but have fled away, and the home buyers are left in despair to get that house and go in courts and everything. Of course, now because of the RERA, a lot of policies like these have made a boost to real estate, but also to help the consumer point of view. I'm trying to understand from you, when you guys invest in stressed project, what kind of key factors do you keep in mind while evaluating such projects? Because earlier what we had seen where these private funding was coming in for the help of the developer project to get, completed, that kind of funding was used for other projects by the developer. Those kind of malpractices were happening. How do you make sure such things are also avoided? Of course, now there is an escrow account and everything, but what do you keep in mind before taking upon the project?
It's a fantastic question, Kritika. I think it's always to do with the opportunity and the intent, both. So there's the soft factor and the hard factor. The hard factor is a very simple analysis as to what went wrong and is it because of intent. Now, if there is a stress, it has been percolated because of certain factors. It could have been market, or it could have been regulatory, or it could have been because of failure of one of the stakeholders. And that's okay because there was no misintent there. We didn't know that this is going to happen. Or it could be environmental, right? And I say market or environment. So, which means that there was a black swan event, or there are certain regulatory changes which happened, which stopped construction because of NGT or because of certain issues that the governments or the regulators decided must be surfaced or dealt with, because of which everybody was affected, and that project also got affected. So those things are understandable because fundamentally the idea is still solid, the intent is solid, but there are very clear, definable events or issues which were not forecasted, and nobody could have forecasted that. It was not a problem with the promoters or the project itself, but it has affected a large number of people. So that's okay, right? Because you still started with the right assumptions, you started with the right product, you started with the right idea, and you ensure that you worked on that and you tried to deliver that product till such time those events started panning out and it disrupted the project. So now that if those issues are solved and the issue is only capital, which means the regulatory issues are solved and the environment is back normal and everybody's able to start work again, or whatever those issues were, have been sorted, and now the need is only money to now effectively complete an exit, there's no problem, right? But if the issue was intent, because there is no equity left in the company, monies have been taken out, so now there's no incentive for the promoters or the stakeholders to actually complete it, because even if they did, all the money is to the bank, then obviously that's not the right product for us. So we have always been very, very selective. When we looked at about 500 investment opportunities last year, we only did 12. So it's very important to identify the right partner, the right counterparty, and help solve a particular cash flow issue wherein the interest of all stakeholders still remain aligned, which means the home buyers are still with the project. They're not trying to take down the developer. The developers have made all endeavors to ensure that he's able to communicate to the home buyers. These are the issues because of which I'm unable to complete and I'm trying to solve it. And he's made extraordinary efforts to try and address it and still keep things in motion, which means the intent is demonstrable.
Hmm.
And there's enough skin in the game of all stakeholders involved, whether it's the
Yeah.
promoters, whether it's the buyers, whether it's the landowner, everybody's still aligned and they want that thing to happen.
Hmm.
If only I want it to happen as an investor because I see a profit, then I'm fighting against the tide because nobody
Yeah.
else wants it to happen. That's a
Yeah.
bad idea. Money itself can't solve everybody's angst
True.
or issues.
Hmm.
But money is only a plug. So long as that money is acting as a plug to actually complete the jigsaw puzzle. Otherwise, it's all looking still good. There's just one piece, which is money, which is missing. The moment you put it, it looks perfect. Then I'm okay with it. But everything is in a disarray, and it has been, it will continue to be in a disarray. Then that's something which that piece can't plug. So I think that's the first and foremost. Second is, and therefore, what really goes down is how much time you spend behind in every investment opportunity. We spend 6 months sometimes at a go, trying to understand the promoters, understand the micro market, due diligencing the customers, due diligence if there are any issues, cases, litigations, or any other, things that we may discover formally or informally about the concerns that may be existing for the project or within the stakeholders of the market. So I think once all of that process is done and we feel, well, there's nothing really which sprung up at us. It's a genuine issue.
Yeah.
I think then that deserves our capital. So because we're not trying to create a very large book. Let's be a $5 billion fund. That's a problem, I think.
Yeah.
India doesn't have the debt. We don't have the opportunity to put $5 billion at work in a year in our country. It's still a shallow market.
Yeah.
We're still trying to build. We're still trying to create large companies. What one company in one of the major economies sells in a year, our entire market doesn't sell in a year. So that's such a stark difference. So obviously we have to be very careful. I believe that even if he can put 200-300 million dollars to work in a meaningful manner, I think that's good enough for us. We're not trying to put too much capital to work because I don't think it's easy for anybody in the country or there's any balance sheet strong enough which can actually take too much capital, especially which is in the nature of debt, and return it back in time with the requisite returns that we ask of. Because it's private money, it's not bank money, it's not deposit money, it's not cheap capital, it's expensive money. So if anybody's taking too much expensive money for a longer period of time, there could be challenges which will erupt, even if we don't know what they are, because we didn't know what they were 5 years ago. When we're now looking at something which is broken, we're trying to fix it. It can again get broken 5 years later. So long as the money is short, it's tight, it's for a small period of time, it helps solve that problem quickly and gets out quickly, I think we're in good hands.
But help me understand, when you filter out the stress projects, as you said, last year you invested in 12. So when you filter one project, let's talk about one project. Like recently, the project that you invested was 24 crore in that Gurgaon project, right? How do you make sure, or how do you monitor that working capital that you provide to that stress project?
So this is why I just mentioned some time back that this is an operating asset class, and we've always dealt with it like that, which means that I need to know every variable, and we need to be able to control all of that ourselves or have a view on that. So even from day one, when we started actually crafting our documents, we always had this mechanism of escrow control. We always had this mechanism of having a PMC on site. We always had the mechanism of actually implanting a CFO on the project who can actually monitor daily cash flows and take control of accounting, taxation, and other statutory and cash flow liabilities or controls. So I think that is something which we had as a discipline from day one. So it's not something which people are maybe discovering today, or they're saying, "Oh, by the way, we're doing this today." We've been doing it for 15 years. So I think that's very important, because when you realize and when you recognize this is an operating asset class, you need to plug yourself in as a lender into the project as if you're a partner in the project. So even though it's a loan, but a loan left by itself, can create an issue. It must be monitored. And it doesn't matter who the counterparty. It can be the largest, the biggest, the bluest, or it can be the smallest and the most undiscovered or unknown character. It is irrelevant. I think the most important part is us knowing what is happening and what can go wrong. Which is why, because we're able to do that, we know way ahead of time that there is something which is not going right. Cash flows are slowing down, construction is slowing down, collections are not coming as forecasted. So there's something which is going amiss. So before it becomes too late, one is able to actually step in and take corrective action. Okay, what is going wrong? Are you not able to collect? Is there a concern? Are people not wanting to buy? Are people not wanting to put their balance money? What is the problem? How are we going to solve it? What is it that we're not, what is it that the project is not doing right, which is supposed to? So all of these questions start getting deliberated upon, and we try and find a very quick solution so that it goes back up to the cash flows and the business plan. So it's very important that when you actually, because see, when I started by saying it's a securitization product, there is a predictability of cash flows, and that prediction is already set up upfront, that if I'm putting 100, I need to receive 150 or 140 in, let's say, 2 years. To get that, I must know what is it that I'm going to get every month, every quarter. And if there's any slowdown, it's obviously going to affect the repayability at some point in time. So the ability to actually plug that very fast and take corrective action is very critical. So that's really what we've been doing and that's why you need to know the market well. You need to know what consumers are saying. You need to know what brokers are saying. You need to know what buyers are thinking. You need to know what the regulator is thinking or saying about a particular project or a micro market or a developer. What are the issues that the developer is facing at large? Could not be in the project, but could be outside of the project. Could be elsewhere in something else. So I think keeping that eye open, keeping your ears to the ground, understanding what shocks are likely to happen at some point in time, because the tremors are already being felt, and taking corrective action before that is very critical. I think that's where, operating it on a regular basis, knowing what's happening is, I think, the only way one can actually stay completely secure and safe, because nobody's going to tell you the bad news today. No borrower is going to tell you the bad news today. He's going to keep it in their heart, and when it comes, he says, oh, by the way, this happened, now let's find a solution. And that solution may not be something that you like, but you have no choice but to accept it at that point in time. So it's better to actually preempt all of these things ahead of time. So that's what we've always maintained, that if we cannot be in a role, even though we're lenders, and a lot of borrowers say, well, you're a lender, you will get your returns, why do you worry? I said, well, if that was the case, then I would be sitting in the bank. I'm not sitting in a bank. But I'm not sitting in the NBFC where my job is to only dispense money. My job is to ensure returns. I'm in the business of generating returns, not dispensing capital. So if we are able to agree the fact that we can plug ourselves into your system, and you're willing to be transparent, and you're willing to have everything disclosed like you would know yourself or more, then I think we're the right partners. So I think keeping those sort of check boxes and cornerstones is very important. And we've always done that. So, people who've actually not done that, up, where monies have gone out, the project has suffered, people have tried to sort of, have, money circulated across multiple opportunities without ensuring that one guy gets paid. So I think that's a common problem, because that's also been the bane of real estate developers, is that capital is limited, opportunities seem large. So with that limited capital, how do you spread your bets? That's really when you start to sort of, move capital around. And sometimes knowingly, unknowingly, people do agree to it. That, okay, I mean, there's enough cover, but cover is just a number. I think it's about discipline. It's not about mathematics alone. It's not just about metrics alone. It's not about saying whatever I underwrote is still being maintained. It's about the discipline. It's about the intent, both at the lender's end as well as at the borrower's end. So we've always recognized that before we've recognized the numbers.
So I've seen few developers projects, where they have taken help from L&T, and L&T has finished the project. But what do they have said is that during the end, for example, a project is getting end in 2 years, they have to make sure that they pay the L&T guys. If they don't, by the end of the 2 years, when L&T has finished the building, they take up the project and sell it according to their, by putting the ticket prices and all. Why I'm talking about this? To try to understand, when you are going through these stress projects where you're providing the working capital, there might be times where you would have seen during the where you say that, we find out the problems, but finding out the problems also, there are times where you can't find the solution. Sale ho nahi rahi hai, to it's not selling, right? आपका unit नहीं बिक रहा है. So then what kind of exit strategy then you do, and how you make sure your investors' money is intact?
Good point. So two cheeses. First of all, it's a running project where fundamentally it must be a project that the market likes. Okay, and that is demonstrated by the sales MIS. So when you start looking at data, you say, okay, you launched the project in year X, and now it is X plus 3 years. Where are you? So, and how has the market behaved with your project? how many walk-ins came, how many people actually bought, how many people are now existing buyers, how many people are looking to exit because they don't think this is the product they like. So purely from historical data itself, one can find a significant amount of behavior or attraction for that project. What has the consumer really? Having said that, of course, preferences of consumers may change
Yeah.
with time, right? So there's nothing wrong with the product 5 years ago, but today people don't like that product. They like with more amenities, they like larger spaces, whatever that may be. So that's really when we do a dipstick with, let's say, a group of brokers or sales agencies, that if we were to give this project to you and there's X amount of inventory left to sell, what do you think is going to be the outcome? Now, these are people who sell the maximum amount of inventory in any city. So we'll actually call them in and we'll have a focused group discussion saying, let's go out and find out and tell us what you think. So, and it's a very high probability that the guy who gives me the best answer will actually walk away with the mandate to actually sell the balance inventory.
Yeah.
So there's an incentive built in for them saying, and we've done that in a lot of projects. We've actually appointed these agencies or mandate holders to actually sit on the site and ensure, basis the analysis, basis the segmentation, basis the demographic profiling or the consumer surveys that they've done, that this is what will happen at this price point. That's what we'll agree then upfront with the borrower, that this is what is going to happen. You may have to discount the price. You may have to create a certain payment plan. Whatever is it that the market is telling us today, you will need to implement those strategies upfront so that we're not then left to fight or discover later what we should have done prior to investing. And fortunately, Kritika, things don't change that fast. It's a 5-year cycle.
Yeah.
Which means that consumer preferences, locations, micro markets, consumer behaviors will alter a bit, but every 5 years. We're not there for that period of time. We're trying to exit much sooner. And if a product is decent, meets the demands of the consumer, the home buyer in that micro market, at some price it will sell.
Yeah.
If I'm in Andheri and if something is selling at, let's say, 28,000 or 34,000, but I have a 3 times cover, which means that till such time that it sells at 10,000 rupees, my capital is protected. Will there be a buyer at 10,000? Of course there will be, but I don't need to sell it at 10,000. I don't want to make a loss for the shareholders and the promoters. But maybe it'll sell at 22,000 also, if not 28,000.
Yeah.
Because maybe it's not as glamorous or as overspec a product as what the next door guy is building at 28 or 30,000. But my product, so there'll always be a demand. And I think that's very fundamental, that because the consumers are so large, the demand is so large. And if it's a core product, if it's a product that people actually want to stay in, okay, it's not a penthouse, it's not a service apartment, it's not a fancy asset, it's actually a core housing asset, it will sell at a certain price. So we've already done that discovery ahead of time, and we've ensured that those systems are at work. And we always have a plan A, plan B, plan C. So plan A, this guy goes out and sells that much balanced inventory, and the rest of the receivables are anyway coming from sold inventory. Because we've also, by the way, gone and checked with the buyers: are you happy? Are you likely to pay? Or are you likely to cancel once we step in? Or are you going to have a problem? Okay. So if people are happy that no, please go ahead and complete this project, we want possession. We're not here to cancel. We're not here to recover extraordinary amount of profits from this project. We actually want this because when we invested, it was X. Today is X plus 40% or X plus 30% price. And I'm not going to cancel and try and pay 30% more to buy another apartment. I really want to actually stay in this location. So then that is a fundamental issue. And that's really what we're addressing. We're not looking at speculative developments. We're not looking at speculative outcomes. We can't have that. The whole idea is that it must be fundamentally, it must be rooted, it must be discoverable, it must be demonstrated, it must be proven. When you have that, then there can be no reason why it can go wrong. So yes, we've asked people that, okay, by the way, you think that you've sold at 18,000 today, but you sold it 2 years ago. 2 years you had a gap. Today market is 24,000. Sorry, I don't think you're going to sell at 24,000. Let's keep 20,000.
Yeah.
Let it be a 15-20% discount to the market. At 20,000, market is there. So that understanding has to be very clear with the borrower that this is a cash flow business. I'm not here to maximize my profits. I'm here to actually exit this project. Because the problem of not exiting in time is far greater than the profits you might make or might not make if you have to hold on to the inventory at a certain price point. So once there's alignment that this is a cash flow issue, we need to plug it. We need to ensure that cash flow start, and I need to complete an exit and deliver. Then I think we're on the same page. I don't see a challenge with that. And again, so what are the challenges really? A, it could be the product is really bad.
Yeah.
We already know that. So a lot of projects come to us, Kritika, where 60, 70% complete, but zero sales.
Mm.
I'm like, Bhaiya, kya kare? Why are you not selling? And why? And then you're stuck and you want us to help you out? No, no, sir. When it completes, we'll sell at 2 times the price. I said, then that's for you to take home. And I think it's for you to stay. It's
Yeah.
not for the market. Because what is not selling, what is not sold, is not something for me to discover.
Mm.
It must be a selling. And that's the advantage we have, that today in India, we always have off-plan sales.
Yeah.
Residential is a off-plan sales market. Unlike in many mature markets where you need to complete and then sell,
Then sell. Yeah.
we don't have that problem here. Which means you can actually discover demand, you can discover price, you can discover consumer behavior very early into the cycle. Upon launch, at ground level.
Yeah.
So you can't tell me 70% completion later that I'm waiting, the demand is crazy. People are actually begging to buy this product, but I'm not selling. I'm like, there's nobody big enough to actually hold on to resi inventory of such great value, for 4 or 5 years. So I think it's very clear that there must be a market, and that market must be known to us. Who's the buyer? Who's the consumer? And when you look at the data, you already know these are the socio-economic segments, these are the communities who are buying, this is the locality where more sales are happening. So you already know the pattern for that project. Then you try and extrapolate it. Then you do a little more market research, which is why we spend enough time. When you spend enough time, you already know the answers. And fortunately, the answers won't vary too much. Yeah. There's enough margin of error built in into our assumptions. So I think we are therefore fine because the actionable points are already set out in the business plan.